Recording in progress.
Good evening. We'll start the class. Sorry for being late to start the class. So we'll take the revision kit, please. Just see whether we have a question in the name of Aaron. It is from Financial Instruments, ARON. Yes, ni? Okay, ne? Right. Can we go to the question? Priyanka, what is the question number? 59. 59. Okay. It is 59, question number 59 in the new revision kit. And if you can't find the question number, it is a question from Financial Instruments. Starts with Aaron, ARON. Okay. Can I start? Can I start? Yes. Can I start? Okay, thank you. The directors of Aaron would like advice with regards to some financial instrument transactions that took place during the year ended 31st March 2007. Aaron issued 1 million convertible bonds on 1st June 2016. The bond had a term of 3 years and were issued for their fair value of 100 million, which is also the par value. Interest is paid annually in arrears at a rate of 6% per annum. Bonds without the conversion option attracted an interest rate of 9% per annum on 1st June 2016. The company incurred issue cost of $1 million. The impact of the issue cost is to increase the effective interest rate to 9.38%. At 31st May 2009, the bondholders can opt to be repaid the par value in cash, or they can opt to receive fixed number of voting shares in Aaron. Let's look at the remaining two questions after answering part 1. Required advise Aaron on how to deal with the above transactions in the financial statements for the ended 31st March 2017. So it's quite obvious. It has been given from financial instruments. So we have two accounts. So basically, there are three, but we did only two. IAS 32, presentation of financial instruments, and IFRS 9, recognition and measurement of financial instruments. Which accounting standards do you think the question has been given from? It is from IAS 32 or IFRS 9. Which part of the standard is the question given from? Which part of it, which part of the standard is the question given from? Can remember? Yes. Hurry up. Yes. Hurry up, please. Come on. And if you can't remember, just let me know whether you can't remember. Then we can straight away go to discuss the answer. Hurry up. Quickly. $32. Quickly. Shall we start discussing then, please? Yeah, it is IFRS 9. I mean, it's from financial instruments, true. What I'm asking is whether it is from IS 32 IFRS 9. It's not from IFRS 9. It's from IS 32. Which part of IS 32? It has been given from compound instruments. Compound instruments. Can we remember compound instruments, or you want me to explain? Yes or no? Hurry up, quickly. If you do not know, please let me know. We can then quickly start discussing. If not, we are wasting time. Hurry up. Okay, we'll start discussing. Better, ne? Right. Need a briefing first? Okay. Now, in financial instruments, maximum we have only two items. It is either financial assets or financial liabilities. Financial assets, financial liabilities. Whether it is financial asset or financial liability, they are initially taken to the books at which value? Fair value. So we can take the fair value only from two sources. What are the two sources? It has to be either from active market or it has to be from an arm's length transaction. Arm's length transaction. Okay. How do we identify an arm's length transaction? In an arm's length transaction, the parties in the transactions do not have any relationships. They have only buyer and seller relationship, lender and borrower relationship, service provider and service receiver relationship, and there's no any other relationship. One simple example to remind. Say someone will apply for a bank loan at $100,000. And that's from the bank, and the bank is offering the loan at 20% annual interest rate, and the borrower will be required to settle that in 1 year's time at 120,000. Is the transaction an arm's length transaction? Yes or no? Yes or no? Yes. Why? The transaction occurs at the market terms. So the lender is only the lender, borrower is only the borrower. Other than the lender being the lender, he does not have any other relationship. Other than the borrower being the borrower, he does not have any other relationship. Okay, right. Now, the value of the transaction should be fair value, while the transaction is arm's length transaction. Let's say this borrower, without borrowing money from the bank, is borrowing money from the employer. Now the employer will be granting 120,000 worth of a loan, requesting it be paid in 1 year's time at 120,000. What is the market rate of interest? 20%. The transaction seems to be now an arm's length transaction. It's not an arm's length transaction any longer. It's not an arm's length transaction anymore. Why? Where the market rate of interest is 20%, the employer has granted the loan at what rate? 0%. So now the employer, the lender is not only the lender, he has been the employer as well. The borrower has not only been the borrower, he has been the employee also. What makes the lender bring down the interest rate from 20% to 0%? Because of this extra relationship. What is the extra relationship? Employer-employee relationship. So for you to make it an arm's length transaction, what relationship need to be removed? Employer-employee relationship need to be removed. How do we do that? You need to argue how. For the employer or for the lender to recover 120,000 worth of a loan in 1 year's time, what loan value should be granted today at the market rate of interest of 20? So how much is it? 120,000 divided by 1.2. That is 100,000. Okay, 100,000. So what is it looking like now? It is like the employer granting 100,000 worth of a loan, acting as a bank in the market at the market rate of interest of 20%, expecting 120,000 in 1 year's time. How much has the employer given in total? Employer has given altogether 120. So what is the balance 20,000 then? Balance 20 is not like a loan given. That's like a payment given, paid to the employee to recover, never to recover. Never to recover. So if the employer gives something to the employee not to recover ever, that has to be a financial asset, or that has to be part of IS 19. IS 19. Okay, IS 19. So the employer granting this interest-free loan of 120 to recover in 1 year's time at 120 is involving how many transactions? 2 transactions. So it's like the employer first acting as a banker in the market and granting 100,000 to recover 120 with the market interest rate of 20 and giving another 20,000 not to recover ever. Is it clear? Please, you all need to answer quickly. If it is clear, yes. If it is not, just say no, I will explain it. If not, we are wasting time. Hurry up. Is clear? Okay. Now, we'll come to compound straight. If a company issues a bond at 100,000 at market rate of interest of 20%, and this is to be settled in 1 year's time at 120. So this is on arm's length basis or not on arm's length basis? So the value of 100 should or should not be fair value? Should be fair value. Okay. Now the company is issuing a bond at 120,000 to settle 120,000 in 1 year's time. 1 year's time. And the interest rate at which the bond is issued has been 0%. 0%. 0%. Why are we issuing the bond at 0% when the market rate is 20? So there has to be some other relationship. What is it? The company says, look, either you can collect 120,000 in 1 year's time in cash, or you can receive 12,000 shares of the company. 12,000 shares of the company. That depends on your preference. So we have taken money not just from a lender in the market, we have taken money from a prospect shareholder in the company. He's not only a lender, also whom? A prospect future shareholder. Clearly. So what has made him to give us the loan at 0% interest when the market rate was 20? Because of the extra relationship. What is the extra relationship? Company and the future prospect shareholder. Okay. So then this transaction is not on arm's length basis. So the value is not the fair value. You need to convert that into fair value. How? You need to think reverse. For us to settle 120,000 in 1 year's time, if you issue the bond at the market rate of 20, what value are we issuing the bond at? 100,000. 100,000. So it's like we're receiving 100,000 from the lender at the market rate of interest of 20 and receiving 20,000 as a loan or as the capital for the future share issue. Capital for the future shares. So this instrument is including together how many components? 2 components. What are the 2 components? Debt component and equity component. An instrument which is including debt and equity component together is called what? Is called a hybrid instrument. Is called a hybrid instrument. Okay, ne? So as per IS 32, where there is a hybrid instrument, you need to apply what accounting? A split accounting to separate out equity component from the liability component. Okay, ne? Right. We'll do the calculation. What is the face value of the bond? Face value and the fair value is the same. They say that the bond had a term of 3 years and were issued at fair value of 100 million, which is also the par value. Okay. What is the maturity value? Sorry, maturity date is what? We need to redeem it by 31st May 2019. How many years of maturity? 3 years. To calculate the fair value of the liability, what do we need to do? You need to take year and you need to take cash flows. Okay. And then we'll take the present value of the cash flows. Present value of the cash flows. Year 1, year 2, year 3. What are the cash flows? What interest are we to pay? Interest is paid annually in arrears at a rate of 6% per annum. 6% per annum. The fair value is 100, par value is 100 million. So what interest are we paying? Here 6, here 6, here 106. 106, okay, right. To calculate the market value, fair value of liability, this has to be discounted by what rate? Bonds without the conversion option attracted an interest rate of 9% per annum. It has to be discounted at 9%. Okay. So this is to be discounted by 1.09. (1.09) squared. This is 1.09 to the power 3. So what is the fair value of the liability? Then say proceeds. From the bond. How much? It was 100. 100. And then value of equity. Value of equity component. How much? 100 minus 92. 100 minus 92. That is okay. But there's another information given. What is it? It says there is the company incurred issue cost of 1 million. Issue cost of 1 million. So normally, when you do a bond issue, we will get it issued through whom? Like, there are investment banks or merchant banks. So then they are charging us how much? 1 million. So though we are issuing 100 million worth of a bond, we have collected not 100 million, we collected only how much? 99 million. Now, if you total up equity component and liability component, that will total up to how much? 100. Have you collected 100? No. Then what you must do is, you need to deduct this issue cost proportionately from equity component and liability component. I will just open up 2 T accounts. That's not necessary at the exam, just to explain. Okay, right. We'll open up 2 T accounts. This is equity component. Liability component. Liability component. So debit cash and credit to equity component by this one, and will credit liability component by this one. Okay, right. Is it correct? Okay, correct, yes. So the issue cost of 1 million has to get deducted proportionately from equity component and liability component. Then 92% of issue cost is attributable to liability component. How much is it? 0.92 million. 0.92 million. Say transaction cost or issue cost. Then 0.02. 0.02 of the issue cost, made mistake, 0.08. 0.08 is attributable to the equity component, issue cost. Issue cost. Okay. Right. Now, if you take the net amounts of equity component and liability component, we will get a total of how much? It's only 99 million. 99 million. 99 million. Okay, right. Then forget about equity component. It does not need another subsequent measurement, but this liability component need to be subsequently measured at which value? Liability component is a financial liability. Coming under which category of financial liability? How many categories of financial liabilities did we have? We have only two. What are the two? Fair value through profit and loss and fair value through, amortized cost. This comes under fair value through profit and loss, so amortized cost category. Amortized cost category. To calculate the amortized cost, what do we need? To calculate amortized cost, what do we need? To calculate amortized cost, what do we need? We need a tool, a small tool. What is the tool? It is effective interest rate. Effective interest rate. So normally in the class, we used to do the calculation, but the examiner has not as bad as we are, and he has given the effective rate. What effective rate do we take? 9% or 9.38%? What effective rate are we using? It's 9% or 9.38%? 9. Okay, we'll explain. Right, see, you need to redeem 100 in say 1 year's time. Okay. Say you need to redeem 120 in 1 year's time. Present value of the liability is 100. So for you to bring this, say this is 109. The value to be redeemed is 109. So for you to bring this present value to maturity value, what rate are we using? 9%. But then we are deducting transaction cost of 9 from the liability component. So what is the liability component value after deducting transaction cost? For you to bring 91 up to 109, can we use 9%? So what should be the rate then? 9.38. 9.38. Okay, so we'll calculate interest at 9.38 for the first year. Interest at effective rate, effective interest rate. Okay, ne? So 9% should apply on 92 or 92 minus 0.92. Yeah, you need to apply that on the value after transaction cost. Okay, it is so interest has to be 8.58. Are we paying the first year coupon in cash? Yes, we pay the coupon in cash every year. We pay the coupon in cash every year. What is the coupon? Coupon has to be 6%. So that has to be 6. It has to be 6. So we'll take the amortized cost end of the first year. Just two, yeah. So we'll go to the second year beginning 94.07. So we'll recognize interest at effective rate of 9.38. We'll pay the coupon in cash. Take the interest at coupon rate for the last year. And let's pay the last year coupon in cash. It is 6. So the balance outstanding will be 100. There's a small rounding of error. Now you speak to the bondholders. You ask them how they want us to do the settlement. If they want us to settle in shares, we will debit liability account by 100 and credit to share capital by 100. And if the investors prefer the settlement in cash, you debit to liability by 100 and credit to cash by 100. Okay, ne? Right. So this is just the working only, but this is not the final answer. How many marks? 6 marks. To get the 6 marks, you need not to provide this T accounts. Okay, ne? T accounts are not needed. They want us to advise on how to deal with the above transactions in the financial statements for the ended 31st May 2007. Okay, ne? Right. So they have issued the bond on 1st June 2006. They want us to show the accounting in 1 year's time from the date of the bond issue. You want me to dictate the answers or you all can just manage? Better to dictate. Okay, we'll take down. It says 6 marks. 9 marks.
This is the complete treatment of the convertible of the financial statement for the year that 27.
Okay, it says 9 marks.
9.
It's worth 9 marks, not 6. Okay. Take down the answer. As per, okay, now when the action verb is advised, we have to give them instructions. Okay, instructions. So you need to give instructions on how this is dealt in the financial statements. About in the financial statements for the end of 31st May 2007. Say, as per IS 32, IS 32 within brackets, presentation of financial instruments comma a debt instrument with a conversion option issued at a rate of interest lower than the market rate of interest is a compound financial instrument that requires the split accounting of IS 32. IS 32. The equity component is separated from debt component. The fair value of the liability is determined by discounting the future cash flows at the market rate of interest of a similar instrument without the conversion option. the fair value of the debt component is deducted from the total proceeds of the bond in order to determine the equity component. New line. The issue cost of $1 million should be proportionately deducted from the equity and debt components. New line. Equity component does not need a subsequent measurement. Liability component should be subsequently measured at amortized cost at the effective interest rate of 9.38%. 9.38%. Interest expenditure for the year ending 31st May 2007, whatever the year, should be 8.58. 8.58. Amortized cost as at 31st May 2017 is 94.07. 94.07. Statement of financial position should recognize 94.07 under non-current liabilities and .75 7.51 under equity. 7.51 under equity. That's the whole answer. For 9 marks. Yeah. 6 is not enough. Okay, is it clear then? So we are moving to question number part 2 of the question. Are you okay? Thank you, Jathuran. Aaron held 3% holding of the shares in Smart. Thank you, Lasar. Aaron held 3% holding of the shares in Smart, a public limited company. The investment was designated upon recognition as fair value through other comprehensive income, and as at 31st May 2017 was fair valued at 5 million. The cumulative gain recognized in equity related to this investment was $400,000. On the same day, the whole of the share capital in Smart was acquired by Given, a public limited company, and as a result, Aaron received shares in Given with a fair value of 5.5 million in exchange for its holding in Smart. Advice Aaron on how to deal with the above transactions in the financial statements. Just in 2, 3 lines, can you all just give me the answer? Just take 1, 2 minutes or 2, 3 minutes. Okay, then we will start discussing. You can't take long time. You need to finish it soon. And if you can't do it, just let me know so that we can start. Yes. Okay. Company A has had shares in Smart. Investment was designated upon recognition. It goes under fair value through OCI. By 31st May 7, what was the fair value? 5 million. It was 5 million. Then the cumulative gain recognized in equity relating to this investment was $400,000. What is it? You initially measure it at fair value, subsequently measure it at fair value. Fair value changes are recognized where? Other comprehensive income, equity. So there is a cumulative fair value changes. Yes, Chatura. Cumulative fair value changes recognized to equity is how much? 400,000. Okay. Now what does it say? On the same day, the whole of the share capital of Smart was acquired by Given. So Given company Given has acquired total shares of S. In other words, the 3% shares which company A is holding in company S also would have been transferred to whom? Given. If not, Given cannot acquire all the shares in company Smart. So it's like company A selling their 3% equity holding in company Smart to which company? Company Given. As a result, A received shares in Given with a fair value of 5.5. It is a share exchange transaction. Okay. Now, two things are there. Investment in the shares of Smart should be continued to be recognized or should be de-recognized. Should be de-recognized. And the shares in company Given should be recognized. Under which category? Under which category of financial assets? OCI. So then initially, the shares of company Given should be recognized and measured initially at which value? Fair value. What is the fair value? 5.5. So it's like company A selling 5 million worth of investment for 5.5 million and making a profit of how much? 0.5 million. That 0.5 million should be recognized to profit and loss. Disposal profit should be recognized to profit and loss. So OCI. That goes to profit and loss. Disposal profit. We had investment at 5 million. It was sold at 5.5. So there is a disposal profit of 0.5 million. It has to be recognized to OCI. There's one small thing more to be done. What is it? Equity amount 400,000 should be transferred where? Retained earnings. You all want me to explain the reason? That 400,000 fair value changes recognized to equity, cumulative fair value changes recognized to equity can be transferred to retained earnings. If you want me to explain the reasons, I don't mind explaining. If not, we'll take down the answer. Okay. Take down. This is a sale of a financial asset by Aaron to company given. Company given. The investment in the shares of Smart should be derecognized. Should be derecognized. Now in IFRS 9, I have given you 4 instances where financial assets need to be derecognized. So what are these 4 instances? Where the financial asset stops generating cash flows to the business. Where risks and rewards incident to the ownership of the financial asset pass to another party. Where the control of the financial asset passes to another party. Where liabilities are incurred on the financial asset. So why do we derecognize this financial asset from the books of the seller? That is company Aaron. Why do we derecognize it from the books of company Aaron? We transfer risk and rewards. We transfer risk and rewards. They recognize as the risks and rewards incident to ownership of the financial asset is transferred to given. The consideration received less carrying value of the financial asset should be the disposal profit and should be recognized to profit and loss. Should be recognized to profit and loss. New line. The consideration received. The consideration received is another financial asset which need to be recognized under fair value through OCI and should be initially measured at fair value of 5.5 million. Should be measured at 5.5 million. Should be measured at 5.5 million. Then say the cumulative fair value changes recognized to equity may be transferred. It's not mandatory, may be transferred to retained earnings of US dollars of how much? 400,000. 400,000. So is that part of the question hard?
Investment is 5 million and you have so far put 400,000, that is 4.5 million. You received on the shares worth of 5.5 million. And the one fact is the net gain to the equity if you see the total. But we are recognizing the 500,000 is the P&L, and there is a transfer between the
equity and retained earnings. Problem.
Yeah, you don't specify to the P&L, no, that is.
It doesn't go to P&L. It goes only to retained earnings. It knows the reason. Problem. Not clear.
Yeah, but that 5.5 million, then like for the 5 million you are getting 5.5 million worth shares.
Okay.
If you take the like cumulative value of the investment, is
Okay.
it 5.4 million?
Why 5.4?
That cumulative gain we have earned, we have recorded it is under.
Okay, now 5 million is the carrying value now. On the date of the sale, investment is carried at 5 million. It is after being fair valued with a gain of 400,000, or it was before fair valuing with a gain of 400,000. I mean, 5 million is the carrying value of investment after recognizing this fair value gain of 400,000 or before recognizing fair value gain of 400,000. How did you account for this 400,000? You debited investment and credited to equity. Okay, now. So this 5 million carrying value on the data disposal is including this fair value gain or is not including the fair value gain? Including. It's including. Okay. In other words, the original value of the investment would have been how much? It is only 4.6 million. So it's like you selling 4.6 million investment at which value? 5 million. So part of the profit is where now? Part of the profit is in equity. So it's not, equity component any longer. It has to be part of disposal profit. But you can't transfer it to profit and loss. You transfer it where? Retained earnings. There's a reason why we transfer it to retained earnings without transferring to profit and loss. Okay? No, not clear. Okay, clear.
It is not like conduce something like no, it's that you have done basically you have done investment of 4.6 billion and
yes.
It has come up to the 5 million.
Yes.
And 5 million worth investment we are going to sell for 5.5 million.
Yes. Clear? Right. Then, third part of the question, on 1st June 2016, A purchased 10 million of bonds at par. These bonds had been issued by W, an entity operating in the video games industry. The bonds are due to be redeemed at a premium on 31st May 2009. With Aaron also receiving 5% interest annually in arrears. The effective rate of interest on the bond is 15%. Aaron often holds bonds until the redemption date, but will sell prior to maturity if investments with higher returns become available. W's bonds were deemed to have a low credit risk at inception. On 31st May 2017, Aaron received the interest due on the bonds. However, there were wider concerns about economic performance and financial stability of the video games industry. As a result, there has been a fall in the fair value of bonds issued by Vinson and similar companies. The fair value of the Aaron's investment at 31st May 17 was 9 million. Nonetheless, based on Vinson's strong working capital management and market optimism about the entity's forthcoming products, the bonds were still deemed to have a low credit risk. The financial controller of Aaron calculated the following expected credit losses for the W bonds at 31st May 2017. So which part of IFRS 9 is tested? Good. Impairment. Okay. Now tell me, before impairment review, you all need to decide the type of classification of the financial asset.
Yeah.
Good. Others, which category do we classify it under? Which category? Chatura? What is the category? It's classified under fair value through OCI. Why do we classify it under fair value through OCI? So this is a debt instrument where the business model has been both to collect contractual cash flows and sales proceeds. So it's very clearly given. So initial measurement is fair value, subsequent measurement is fair value. Again, you need to recognize interest at effective rate. Okay. Now you need to apply credit loss model to recognize impairment. The final fair value we receive is already including the allowance for impairment. If it is not clear, we have to explain. We need to apply expected credit loss model, or the final fair value we get is already including the allowance for impairment loss. Including. So as a result, the fair value change is now consisting with two components. What are the two components? Market risk and the credit risk. So market risk is what we need to recognize into OCI and the changes of fair value due to credit risk is not the fair value change component. It is the impairment, and that has to be transferred to profit and loss. Okay, right. Need to dictate the answer. Okay. No much of a calculation, but just few items. I mean, no big calculations. Take down. The investment in bonds, investments in bonds should be recognized under fair value through OCI, category of IFR is 9. Category of IFR is 9. This is because the business model, do a small change, please. The objective of the business model is to collect sales proceeds, and please, is to collect both sales proceeds and contractual cash flows. Is to collect both sales proceeds and contractual cash flows. Contractual cash flows. New line. The investment is initially measured. The investment is initially measured at fair value, and subsequently measured at fair value. Fair value changes are recognized to OCI. Fair value changes are recognized to OCI. Interest at effective rate. Interest at effective rate is recognized to profit and loss. Is recognized to profit and loss. Is recognized to profit and loss. New line. The expected credit loss model need not to apply need not to apply. As the investment is measured, at fair value. The fair value change should be separated into market risk and credit risk. Market risk and credit risk. The fair value change attributable to change of credit risk should be the impairment loss. And should be transferred from OCI to profit and loss. Are the values given? Yes. Yeah. Now what has to be the value of the credit risk? It is 0.2 or 0.4. So for that, you need to read the last paragraph. On 31st May 2007, Aaron received the interest due on the bond. However, there were wider concerns about the economic performances and financial stability of the video game industry. As a result, there has been a fall in the fair value of bonds issued by W and similar companies. The fair value of A's investment at 31st May 7 was 9, nonetheless based on W's strong working capital management and market optimism about the entity's forthcoming products. The bonds were still deemed to have a low credit risk. Yes. By 31st May 2007, on the reporting date, the bond is considered to have a high credit risk or low credit risk. Low credit risk. If it is low credit risks, we need to apply 12 months expected credit loss or lifetime expected credit loss model. 12 months. So then the value of the credit risk has to be how much? 0.2 million. 0.2 million. Clear, ne? Right. We'll take down. As per IFRS 9, financial assets of which credit quality has not significantly deteriorated. Credit quality of which, financial assets of which credit quality has not significantly deteriorated deteriorated should be reviewed for 12 months expected credit loss. 12 months expected credit loss. 12 months expected credit loss. The credit quality of the bond, credit quality of the investments in bond, credit quality of the investments in bond, cannot be deemed to have significantly deteriorated, thereby the entity should apply only 12 months expected credit loss model. 12 months expected credit loss model. The amount of impairment loss should be 0.2 million. Should be 0.2 million. Right. Now, what is the total fair value loss? It was initially purchased and recognized at 10 million. Closing fair value is 9 million. So out of total fair value change of 1 million, what is the impairment loss and what is fair value change?
1.2. What is the 1 million change? No?
Okay, 1 million change.
And it is inside of credit risk is inside of that.
No, out of 1 million is including
Yeah.
the credit risk and market risk both. So then the credit risk has to be 0.2 out of 1 million. So the market risk has to be only 0.8 million. Okay, clear? Right, we'll take down. Out of the total fair value change of 1 million, out of the total fair value change of 1 million, out of the total fair value change of 1 million, 0.8 million is the market risk, which is recognized to OCI, and 0.2 credit risk should be recognized to profit and loss. Should be recognized to profit and loss. We'll go to, there is a question from IS 19. It starts with MCVEIGH. MCVEIGH from IS 19. McVeigh, MCVEIGH. Other. Any?
Standard ones,
IS 19. Nani? और अगर रिस्पॉन्ड करने Right, we'll go. Is there a question? The name is FISKERTON. FISKERTON.
Yeah, POA.
Yeah.
Yeah, that is section 27.
27.
Yeah, page 56.
Question number 56, no?
Yeah, 56. December 2018.
Okay, then Safia says question number 27. Okay, right. We'll look at first part, I think, has been from IFRS 16. We haven't still done it. We'll go to next part, sales contract. Sales contract. Okay. F has entered into a sales contract for the constructions of an asset with a customer, whereby the customer pays an initial deposit. The deposit is refundable only if F fails to complete the construction of the asset. The remainder is payable on delivery of the asset. If the customer defaults on the contract prior to completion, F has the right to retain the deposit. The managing director believes that as completion of the asset is performed over time, revenue should be recognized accordingly. He has persuaded the accountant to include the deposit and a percentage of remaining balance for construction's work in revenue to date. What is the question about? In accordance with IFRS 15, revenue from contracts with customers discuss whether revenue arising from the sales contract should be recognized on a stage of completion basis. C. Explain any ethical issues which may arise for the managing director and the accountant from each of the scenarios. Right. So it's about recognizing revenue. We are recognizing revenue at one particular point in time here over a period. How do we recognize revenue? At one particular point in time or over a period. Satura has answered over a period. Yes. Shamila says at one particular time.
Is asking we don't period.
Yeah.
There should be a competition.
There's no point to asking the question there.
I can't remember exactly what is the change that, but as for the correction, it should be 1.5.
Okay. Now, you recognize revenue over a period if there are criteria, there are three, and you need to evaluate the three, and then only we need to decide whether it is over a period. And if none of the criteria is satisfied to recognize revenue over a period, then spontaneously you need to decide that revenue is recognized at one particular point in time. So what are those criteria? you need to see whether the control of the asset passes to the customer as the asset is created. Now, it takes more than 1 year to complete the construction. But as and when the construction is complete, then and there, as the asset is created, as the asset is developed, as the asset is constructed, does the customer receive the control? Now, it happens if the construction occurs on a land which belongs to the customer. So does the question say that the construction is done on a land that belongs to the customer? Does the question say that? No. So it's very unlikely of the control passing to the customer as the asset is constructed. Clearly? Right. Then the customer must consume the asset or the services as the asset is created. Now, in a class, we provide the service and the students consume it instantaneously. So there's no time gap between providing the service and consuming the service. It's not practically possible for us to keep it taught for the students to consume it later, unless we teach it to a platform. Okay, right. So the students consume as we teach. So the question does not say that the customer starts consuming the asset as the asset is created. Or the asset must be a bit of a different asset, where the asset does not have an alternate use to the seller, and the seller must have only the enforceable right to the payment. So is that requirement fulfilled? No. Why? It says they have entered into a sales contract for the construction of an asset with a customer, whereby the customer pays an initial deposit. The deposit is refundable only if F fails to complete the construction of the asset. The remainder is payable on delivery of the. It's like the construction company starting to construct, and he collects an initial deposit, advance payment. That is what normally happening. And finally, everything has to be paid when the construction will be over, and when the control of the asset passes to the customer, then only the customer has to pay the balance amount. Okay. The managing director, okay. So the customer does not get the control as the asset is created. The customer does not consume the asset as the asset is created. So this is not an asset which does not have an alternate use to the seller. The seller seems to have an alternate use. So none of the requirement to recognize revenue over a period is satisfied. So then you need to recognize revenue at one particular point in time. So what is that particular point in time? At what point? At which point are we recognizing revenue? Yes, when the performance obligations are completed. Performance obligations are completed. So when are the performance obligations completed? It's at the time of handing over the keys of the construction, and when the control of the asset passes to the customer. Okay, right. So we'll also discuss the third part, C. Explain any ethical issues which may arise for the managing director and the accountant from each of the scenarios. The managing director believes that as completion of the asset performed over, revenue should be recognized accordingly. He has persuaded the accountant to include the deposit and a percentage of the remaining balance for construction work and revenue to date. So what ethics are of a breach? What ethical principles are of a breach? So what were the ethical issues? What were the ethical principles we discussed last week? Chatra has answered. So we had integrity, objectivity, professional competency and due care, professional behavior, and confidentiality. So which of those ethical principles are of a breach? So we need to discuss it from both perspectives. I mean, perspective of the managing director and the accountant. What is it? Now it's like the managing director. The question says that the managing director persuading is like what? Is like the managing director forcing the accountant to recognize revenue without performance obligations being completed. So what is it? Then the accountant will assume that he's an ACCA qualified accountant. Then he is supposed to know accounting standards. Then him being pressurized by the managing director is like what? Is like him compromising his professional judgment for what? For biasness. The accountant knows very well, as per IFRS 15, without performance obligations being fulfilled, he cannot recognize revenue. So knowing that very well, then the accountant will be tempted to recognize revenue without performance obligations being satisfied. So what is it? It is a breach of objectivity. He is compromising his professional judgment for biasness. Okay, ne? Then there's another breach. What is it? What he does seems to be straightforward and fair. What the accountant does is straightforward and fair, is not straightforward and fair. What the accountant does is not straightforward and fair. Why? He does it knowingly very well that it's against the requirement of IFRS 15. So there is a breach of integrity as well. Integrity as well. Okay, ne? And then there's another problem. There is a problem of professional behavior. Why? If an ACCA qualified accountant does not comply with the laws in the country, and in Sri Lanka, it must be so in other countries as well, accounting standard has now become a law. Okay. So the accountant trying to listen to managing director and acting accordingly is like what? Is like ignoring the laws in the country in that particular jurisdiction. So that will discredit to the entire profession. Discredit to an entire profession. Okay. So there are breaches of what? Objectivity, breaches of integrity, and breaches of professional behavior. Clear? Okay, ne? Right. Need to take down the answer, ne? Yes. We'll take down. As per FRS 15, what is the action verb? Please discuss. When you discuss, what does the examiner want us to do? I don't know how strict the examiner is in action verbs, but in CA, they are very strict in action verbs. I don't think that is very strict in ACCA. We have to develop the answer strictly according to action verb in CA. Discuss means what? You need to study in detail by showing different aspects for another party to come to a conclusion. Now, someone who completes A level is discussing with you whether to start doing SIMA, ACCA, or local CA. You are showing different aspects. What are the different aspects? ACCA, cost is high, recognition high is high, and you can complete faster. Local CA, recognition is high, Cost is low, but you can't complete faster. SIMA, cost is high. I'm not pretty sure about the recognition. I don't know. But you can also complete it faster, a little faster. We are showing different aspects. You don't ask him to start doing ACCA. You will not ask you to start doing SIMA or CH. Let him to decide. What are we doing? We study in detail for the listener to come to a conclusion. We have to show different aspects. Okay, different aspects. Okay, we'll take down the answer. As per FRS 15, within brackets, revenue from contracts with customers. Revenue from contracts with customers. Revenue should be recognized over a period. Revenue should be recognized over a period if any of the following, if any of the following criteria is fulfilled. If any of the following criteria is fulfilled. First one, customer receives the control as the asset is created. Second, customer consumes the asset. Customer consumes the asset as the asset is created. Third, the asset must be of a nature. The asset must be of a nature where the asset does not have an alternate use to the seller and the seller has the enforceable right. Seller has the enforceable right.
Are you ready to practice?
That's good.
Enforceable right for the payment. Enforceable right for the payment. New line, as none of the above criteria is fulfilled, revenue cannot be deemed to be appeal. I made a mistake. Performance obligations cannot be deemed, not revenue. Performance obligations cannot be deemed. Performance obligations cannot be deemed to be satisfied over a period, and revenue cannot be recognized. Revenue cannot be recognized over a period. Revenue cannot be recognized over a period. Revenue cannot be recognized over a period. New line. Company has to recognize revenue. Company has to recognize revenue at one specific point in time. At one specific point in time, which is the point in time at which legal title, physical possession, and risks and rewards, incident to ownership, of the asset pass, and the customer being liable for the payment. Okay. Then we'll take the answer down for part C. Say, because they want us to discuss ethical issues in either scenario, property and sale contract. We'll just leave a property scenario. We'll take sales contract. Take down. The managing director persuading the accountant to recognize revenue without fulfilling performance obligations, is equivalent to the managing director intimidating and forcing the accountant to act accordingly, to act accordingly. There's a clear demonstration of lack of objectivity as the accountant has to act on the instructions of the managing director, Next one. The accountant is not straightforward and not fair in his dealings. If the accountant listens and is a clear breach of integrity. Next one. The accountant is ignoring and circumventing accounting standards, which may be the law in the jurisdiction, and there's a clear breach of professional behavior, as this can discredit the profession at large. Okay. Clear, ne? Problem there. Is there a question with the name of tiles, T-I-L-E-S, tiles? T. නැද්ද? නෑනේ. බලන්න FARHAM 28.
Page number 60.
Page number 68.
ARHAM.
Yes. Yeah. Is it there in the revision kit, please? Can somebody answer? FARHAM. Okay, thank you. Background. F manufactures white goods such as washing machines, tumble dryers, and dishwashers. The industry is highly competitive with a large number of products on the market. Brand loyalty is consequently an important feature in the industry. F operates a profit-related bonus scheme for its managers based upon the consolidated financial statements, but recent results have been poor and bonus targets have rarely been achieved. As a consequence, the company is looking to restructure and sell its 80% owned subsidiary, Nivol, which has been making up substantial losses. The current year end is 30th June 2018. Factory subsidence. F has a production facility which started to show signs of subsidence since January 2008. It is probable that F will have to undertake a major repair sometimes during 2019 to correct the problem. F does have an insurance policy, but it is unlikely to cover subsidence. The Chief Operating Officer refuses to disclose the issue at 30th June 2018 since no repair costs have yet been undertaken, although she is aware that this is contrary to international accounting standards. The COO does not think that the subsidence is another indicator of impairment. She argues that no provision for the repair to the factory should be made because there is no legal or constructive obligations to repair the factory. F has a revaluation policy for property, plant, and equipment, and there's a balance on the revaluation surplus of 10 million in the financial statements for the end of 30th June 18. None of this balance relates to the production facility. But the COO is of the opinion that the surplus can be used for any future loss arising from the subsidence of the production facility. What is the question? Discuss the accounting treatment which F should adopt to address each of the issues above for the consolidated financial statements. Discuss ethical issues arising from the scenario, including any actions which F and the accountant should undertake. So sale of Nivol is another scenario. We'll just keep it aside. What do we do for this factory subsidence? What do you mean by subsidence? What does it mean? Subsiding is what? Can somebody tell me as to what this subsiding is? I'm asking the dictionary meaning. Subsiding. Without knowing that word, you can't answer the question. Subsidence. Subsiding. Yes. Come on. I'm asking dictionary meaning. What is it? Yes. Come on. In Sinhala, we'll call it Gila Bahinu. Subsiding is Gila Bahinu. Okay, right. Okay, so what is it? Which accounting standard is it from? Which accounting standard is it from?
So,
37. That is also connected, but it's not.
PP.
Yes. Which accounting standard is the question given from? Yes. Come on. I'm asking from everyone. Which accounting standard is it given from? Yes. IS 36 is correct. What is IS 36? Impairment of assets. I said in IS 36. So basically there are two categories of assets. What are the two categories? So there are some assets that require annual impairment reviews irrespective of whether we are receiving indications or not. So what were those assets? There were three. What were the three? Goodwill arising in a business combination, intangibles with indefinite lifetime, and then intangibles that are not yet available for use. So this particular asset is an asset that requires annual impairment reviews or impairment reviews when there are indications. This is an asset that requires annual impairment reviews, or this is an asset that requires impairment reviews when there are indications. What is? Come on. Yes. Which category does this asset fall into within the context of IS 36? Assets requiring annual impairment or assets that require impairment reviews? This is an asset that requires impairment reviews when there are indications. So in our discussions of IS 36, I said we are receiving indications from two sources. Internal, this is too much. Look at now. Okay, I said indications can be from two sources. What are the two? It can be internal, it can be external. What are internal indications? There was a lot. Idling of assets, economic actual performance has been lower than expectation. Then a decision to sell the asset, physical damages, curtailment of repair expenses, reducing capital budgets and postponing repairs. And there were a lot of indications from external. What were those? Lowering of market capitalization, increase in interest rates, adverse changes in technological, economic, and legal environment where the business operates, and there were so many. What do you think should be the indications requiring impairment reviews for this construction, for this factory premises? What do you think? What indications has the examiner given requiring impairment reviews? What indications are given? What indications are given? Yes. Yeah, what is that internal indication? Internal indications, yes. What is that, Chatura? Major repairs and subsidence. Major repairs and the subsidence. Then for you to conduct this impairment review, what and what do we need? You need minimum 2 figures. What are the 2 figures? You need the carried value and you need recoverable value. So what is recoverable value? Recoverable value is the higher of value in use and fair value less cost to sell. Okay. Now, even if the asset is impaired, that impairment loss can be cancelled off against this given fair value gain or fair value reserve or cannot be. That impairment loss of the factory premises, factory building can be set off against this given revaluation gain or cannot be set off against the given revaluation gain. Cannot be. Why? The given revaluation gains are the revaluation gains of factory building or revaluation gains are the revaluation gains of some other assets. It says none of the balance relates to the production facility, but CEO is of the opinion that this surplus can be used for any future loss arising from the subsidence of the production facility. You can't use it. Why? You can use revaluation gains to set off impairment losses as long as the revaluation gains belongs to the asset being reviewed for impairments. Then they are now contemplating to recognize some provisions for the future repairs. So can we recognize provisions for future repairs just because we want? Can we do it? Can we recognize provisions for future repairs? Can we recognize provisions for future repairs? That's partly from IS 37. Can we recognize provisions for future repairs? Can or can't? For you to recognize the provisions, what did I say we won't? For us to recognize the provisions, what did I say we won't? Yes. Okay.
Certainty of the.
We basically want the 3 criteria: present obligation, probability of outflowing resources with economic benefits, and being able to make the best estimate. For there to be a present obligation, what has to have happened in the past? An obligating event has to have happened in the past. What is an obligating event? An obligating event is an event which creates no practical means of avoiding that other than you doing the settlement. Now, obligating event has occurred for them to recognize a provision for future repairs, or an obligating event has not occurred, Chatura. An obligating event has not occurred. Has not occurred. So without the obligating even having occurred, you cannot recognize provisions. You can't recognize provisions. Okay, ne? I don't know whether it was clear. Is it clear? I think ගොඩක් අමතක වෙලා තියෙනනේ. කරපො ගොඩක් අමතක වෙලා. Okay. We'll take down the answer. Production facility is an asset. Which requires which requires impairment reviews when there are indications. The factory subsidence requiring major repairs is an indication that impairment reviews are needed. Therefore, the entity as of the reporting date should determine value in use, which is the higher of, I made a mistake, has to determine recoverable value, which is the higher of value in use, and fair value less cost to sell. An impairment loss has to be recognized. Where the carrying value exceeds the recoverable value. Where the carrying value exceeds the recoverable value. New line. The revaluation balance a surplus of 10 million. Revaluation surplus of 10 million. cannot be used against any possible impairment losses. Against any possible impairment losses. Against any possible impairment losses. As the revaluation surplus does not belong to the asset being reviewed. New line. The entity cannot recognize provisions for future repairs. As the following recognition criteria of provisions under IS 37 are not fulfilled. First one, the existence of a present obligation. Arising from a past obligating event. Second, there have been a probability of the entity's resources outflowing with economic benefits. Third, being able to make the best estimate. New line. An obligating event has not occurred. Requiring and please do a change, has not occurred, creating a present obligation. And the entity cannot recognize. Provisions for future repair cost. For future repair cost. Okay. Do we have the question, John, Jon, Jon? Not. Okay, revision kita pada parane emang kita. Tile kile ka mangkiwan ni. Tile.
Check kariye.
Check करा दे.
J, what is it about J? E by N.
John John Jon nani. Player 2 PLAYER player 2. Kira
Question of 51, page number 102.
Okay. We'll take part B. RAP is a public limited company that operates in the media industry. This industry is currently experiencing little economic growth. RAP's market capitalization, the market price per share multiplied by the number of shares outstanding, is less than its net assets value per the financial statements. In accordance with IS 36 impairment of assets, RAP has carried out various impairment reviews. Cash Generating Unit D, a magazine publishing business to which goodwill has been allocated, was tested for impairment and was deemed not to be impaired. RAP has produced the following disclosure note for inclusions in the financial statements. The recoverable amount of Cash Generating Unit D has been determined at its value in use. The calculation of value in use was based on cash flow projections that were approved by management. The average discount rate used by RAP during the year was 10%. The future cash flows of Unit D beyond the budgeted period were extrapolated using an 8% growth rate. Management believes that any reasonably possible change in the key assumptions on which D's recoverable amount is based would not cause D's carried amount to exceed its recoverable amount. Discuss why the information contained in this disclosure may be of limited use to the users of RAP financial statements. Okay. What is it? What is it? So the standard is very clear. And let me know whether the question is clear. Let me know whether the question is clear. Okay, we'll discuss. RAP is a public limited company that operates in the media industry. This industry is currently experiencing little economic growth. RAP's market capitalization, the market price per share multiplied by the number of shares outstanding, is less than its net assets value per the financial statements. In accordance with IS 36 impairment of assets, RAP has carried out various impairment reviews. Cash Generating Unit D, a magazine publishing businesses to which goodwill has been allocated, was tested for impairment and was deemed not to be impaired. What is your assessment? This is a CGU which requires annual impairment reviews, or that requires impairment reviews where there are indications. That's a CGU that requires annual impairment reviews or impairment reviews where there are indications. Yes, Chatura. Why annual? Sorry, Chatura. Yes. It has to be tested annually where there are indications. What are the assets that require annual impairment reviews? In respect, what is it? Goodwill. Can we separately review goodwill for impairments? You cannot separately review goodwill for impairments. Why? It does not contribute to individual and separate cash flows. So then the goodwill which requires annual impairment reviews should be reviewed with other assets. Then we call that group of assets what? We call that group of assets what? Cash generating unit. So that CGU requires annual impairment reviews as a result, or that requires impairment reviews where there are indications. That requires annual impairment reviews. Why? It is a CGU to which goodwill is included. It's a CGU to which goodwill is included. Okay, right. Then it says, and was deemed not to be impaired, RAP has produced the following disclosure note for inclusions in the financial statements. Now, in the disclosures, you need to disclose the basis on which we are identifying CGUs. Apparently, in this given disclosure note, the entity has clearly indicated the basis of selecting and choosing CGUs or has not indicated. Has not indicated. Not indicated. Then the recoverable amount of cash generating unit D has been determined as its value in use. The calculation of value in use was based on cash flow projections that were approved by management. The average discount rate used by RAP during the year was 10. The future cash flows of unit D beyond the budgeted period were extrapolated using an 8% growth rate. Management believes that any reasonably possible change in the key assumptions on which these recoverable amount is based would not cause these carried amount to exceed its recoverable amount. Okay. Now we have learned under IS 36. It says that normally when you calculate recoverable value, you need to make a comparison. So what are the comparisons we are supposed to make? You need to compare value in use and fair value less cost to sell. Recoverable value has to be the higher of the two. So that has not been disclosed here. Nobody knows how the recoverable value was determined. Then, in calculating the future cash flows, I said future cash flow should be based on reasonable and supportable assumptions. So they have not disclosed the assumptions they made just to assess the fairness and the reasonableness of the assumptions. I don't know whether you want me to explain those areas. Then, normally, we calculate the cash flows ahead. We project the cash flows ahead only for 5-year period. And then the cash flows after 5 years should be determined by extrapolating the cash flows of 5 years by a constant growth rate or a declining growth rate. So the disclosure note does not disclose how the cash flows were growing over the first 5 years. How the cash flows were growing over the first 5 years. And then they have just take 8% growth rate and they do not disclose how 8% growth rate has been estimated. And then finally, they have taken the discounting rate and they have not disclosed how the discounting rate was determined. We'll take down the answer. This is a CGU. This is a CGU which requires annual impairment reviews, as it is a CGU to which the goodwill is included, to which the goodwill is included. Goodwill is included. However, the following disclosure notes are not included in the given disclosure note. First, the basis on which how cash generating units are determined. Next one. The assumptions made in estimating future cash flows to assess the reasonableness and fairness of the cash flows. Next one. How the recoverable value was determined. Whether it is by comparing. Value in use and fair value less cost to sell. Value in use and fair value less cost to sell. Value in use and fair value less cost to sell. Next one. How the growth rate was decided. How the growth rate was decided. Within the first 5 years. And next one, how the growth rate of 8% was decided for the periods not covered by most recent budgets. Not covered by most recent budgets. Next one. How the discounting rate was decided. How the discounting rate was decided. How the discounting rate was decided. Is there a question? GARDEN, garden.
Yeah.
GARDEN. Nani? VERG, verge, no. VERGE. No, no. Kawan, apa yang mata di bergerak? අපි next මම මේ ගන්නම් latest revision kit එක. මම ඒක පොඩක් පරණ. කළා මේ මම next week එකේ කරනකොට අර චෝටි standards කීපයක් තියෙනවා. IFRS 8 එකේම. ඒක නිකන් විනාඩි 15න් වගේ ඉවර කරන්න පුළුවන්. කළා අපි questions වලට යමු. And we'll meet up tomorrow to discuss balance part of control. Then we'll meet up tomorrow with the revision class. We'll try to do also control questions by next week.
You can finish.
Tomorrow very well. Cash flow එකක් තියෙනවනේ. Disposal පුළුවන්.
You used to get disposal.